Hello and welcome back to Principles of Accounting 1. I'm your host, Dr. B, and we're going to be talking about cash, fraud, and internal control processes. And just as a quick recap, we just finished a conversation on accounting information systems. And in the classroom, real fast, where we are in the classroom, we're in Module 2, Week 4. We've made it through the first 7 chapters. After we talk about this chapter on cash, we will, you actually have 3 things due this week. Chapter 7 quiz, Chapter 8 discussion board, midterm exam. Midterm exam covers chapters 1 through 8. The chapter we are about to cover probably has about 2 questions on the midterm exam. The midterm exam has about 10 questions total. 2 of them are probably from chapter 8. So just as a little hint, side note. Open book, open note, all that good stuff. And we'll talk a little bit more about that as soon as we finish our discussion on cash. Here we go. Okay, couple of key points. The first things we're going to talk about are fraud. We're going to talk about internal controls, also very important. And then, of course, the most important thing is the cash, right? Cash is what causes businesses to live and die. If businesses don't have enough cash on hand to pay their bills, they go out of business. If they don't have enough cash coming in from their customers, they go out of business. So it's important. It's so important to understand how to manage the cash coming into and out of the business. How do we control it? How do we verify payment? How do we verify cash coming in? So important. Cash is how we operate our business. We pay cash for our bills. We got cash coming in from our customers. So important. And so we're going to talk all about that. And so we need to be able to effectively control our business. We need to mitigate our risk. We need to have plans in place. We need to make sure that our accounting information is accurate. We need to have policies in place and procedures. And we need to be efficient. All of those things are within what we call an internal control system. Without policies or procedures, any business could just do whatever they wanted, right? Without repercussion. That's not a good way to operate your business. You need to have policies and procedures, and they need to be clear. It's like, okay, so in accounting, for example, we get cash coming in from our customers, like a check for their accounts receivable. Well, I need to match that to what bill it is, right? It's like, I got cash coming in from my customer. Great. How do I apply it? It's like, okay, well, I got a check here from my customer, and it doesn't say what invoice it's for or what invoice it's paying. Yeah. So what I do is I look at the dollar amount, find my customer in my accounting information system, and then I start looking through the transactions for that customer. And then I can match up that dollar amount with an invoice. That's how we ensure that our accounting is reliable. And when I post that receipt, I'm applying it to the right invoice. And I take a copy of the check. The original goes to the bank. The copy goes with the invoice, and I file it into my system. Yep. That's a part of internal controls. Another part is protecting the assets of the company. We do that a couple of different ways. you sell inventory, you have what's called an inventory control process or protocol. And you might have like a security tag that gets attached to the product, yeah? Or you might have security cameras or some type of detection device. Or you might have a security guard. You got ways to protect the assets, okay? You might use a safe for your cash and for your checks. That's protecting the assets. You might have security cameras around your warehouse, around your shop. It's protecting the assets. You might have some of your inventory locked up in a cage. That's protecting the assets. These are all ways to control the company and to protect the assets. It's important that all of our companies, any company, upholds their policies. It's like if you have a return policy, make sure that that's clearly stated to your customers. It's like, you bring it back within 30 days. If it's unused, unopened, within 30 days and you have a receipt, we'll give you a refund. If you bring it back within 30 days, but you don't have the receipt and it's unused, unopened, give you store credit. Or if you bring it back within 30 days and it's used or defective or whatever the case is, right? It's all described in the policies. Like a lot of times when you make these purchases at a store, you go to like Best Buy or whatever, and you're trying to purchase some electronics, on the back of the receipt, it'll tell you what the policies are. It'll say, hey, 30 days, unused, unopened, full refund, 30 days, used, opened. It goes through the protocol. There might be some fees involved, restocking fees. It's all described in the policies, right? And it's all right there on the back of the receipt. That's a part of their internal control system. And a part of internal controls is to ensure efficient operations, that things roll smoothly. If a customer comes in and they're bringing back something that they purchased, I want to make sure that return goes smoothly for my customer and for my business. So these are all part of internal controls. The reason why we have such internal controls is, of course, to prevent fraud. Prevent fraud. You have to prevent fraud from happening inside your company. We do that by having an established system of internal controls. And all of this is brought about by this thing called the Sarbanes-Oxley Act of 2002. Sarbanes-Oxley, these were two senators or Congress people that established a series of requirements for businesses that are publicly traded to follow. A lot of this has to do with a major fraud in American history that happened in 1998. And for those of you who have been around long enough, you may remember this fraud, and it was called the Enron scandal. Enron was a major energy company in Texas that committed a series of frauds for financial gain. They overstated sales on their income statement, understated expenses, and because they puffed up their sales to make it look really good, it encouraged more investors. It's like people invest in companies that do well, right? Because you expect to get a greater return off your investment. People don't invest in companies that don't do well. It's like for example, let's say you're like, oh, I want to get into the stock market and I don't know how, what companies to invest in. Well, the first thing you're probably going to do is look at their financial statements. Look at their performance. Are they making good sales? Are they not? Are they managing their expenses? I only invest in companies that know what they're doing. You know, uh, and so Enron didn't do those things effectively, so they lied. They made it look like they had more sales than they actually had. The reason why they did that is because they wanted to get more investors on board, purchase their stock. What happens when you get more people purchasing your stock? It goes up. The price goes up, right? It's attractive. So they lied, right? They overstated their sales. And so they got caught eventually. It took some time because the accounting firm that was supposedly auditing this company, they were also lying. They were saying, "Yeah, that's true. That's true. Yeah, that's true." They're looking the other way. So what happened? Enron collapsed. The company collapsed. The fraud was exposed. A couple of people went to jail. Some of them served life sentences. Millions and millions of dollars of investors' money was lost. Right? So that's what. Yep. Some people committed suicide because what happened is some people invested their entire life savings into this company, and the company lied and went belly up, and people lost their entire life savings. Right? So to prevent that type of fraud from happening in the future, these two Congress people got together and they created what's called the Sarbanes-Oxley Act, and it requires all publicly traded companies to certify that their financial statements are true and accurate. So all publicly traded companies are required to have their financial statements audited by a public accounting firm, and they validate that their financial statements are true and accurate, clear, transparent, etc. There's a section within that they are also required to tell the public what their company's internal control systems are, and which also shows how effective the company is. And so that's the whole reason behind this, right? Is to protect the investors. That's why this act was created. It creates transparency, honesty, and effectiveness of these publicly traded companies. Now, if it's a private company, the thing with a private company is private companies, they don't have to have their stuff audited. They don't have to file these reports. I mean, you have to pay your taxes on the business. But if you're going to be dishonest and over or understate your income, if that company gets audited by the IRS, you're going to need to back everything up. So that's why it's important to really have this system of internal controls. Make sure everything's on the up and up for all companies. So along with this, there's an organization that developed a framework. And this framework is like a way to help these publicly traded companies and other companies to ensure that they are of high quality, that they are doing the right things by their investors, by protecting their assets, etc. It's basically a structure to ensure a system of internal controls. And so this organization, it's called COSO, Committee of Sponsoring Organizations, COSO. they developed this framework, and this framework consists of 5 different things: controlling the environment, assessing the risk, controlling activities, controlling the flow of communication and information, and a system for monitoring. Controlling the environment's about controlling the environment within the business. Okay, both the physical environment within the business and the virtual environment within the business. Okay. Controlling the physical environment would be things like security cameras, locks, safes, etc., right? Physical things. Controlling the virtual environment would be things like dual factor authentication when logging in, verifying that the time reported for employees' wages is accurate based off of a time clock, etc. Risk assessment has to do with analyzing the company's risk. We call this risk tolerance. And risk assessment involves things like making sure that there's not an area where a customer can slip and fall and then sue the company. That's risk assessment. Like, you ever wonder why you go to the grocery store on a rainy day and they have wet floor signs all over the place? That's why. It's called risk, right? You have a risk of falling if the floor is wet. Who would have figured? So the company said, hey, let's put these wet floor signs everywhere to let people know the floor is wet. And so if the customer falls because the floor is wet, you already told them the floor is wet. So they're not going to go suing you. Okay? That's called risk assessment. What you're doing is you're mitigating the chance of something ridiculous like a lawsuit from happening. Risk assessment. And we have things like control activities. You know, when I was working at the hotel, here's a classic example, okay, real life thing. So, as a financial controller at the hotel, one thing that we did on a regular basis is we would audit our inventory, okay? Especially liquor and China, and liquor in China. And every so often we would also audit our linens, because these are the 3 most commonly stolen items in a hotel. Even more so than cash. Who would have thought, right? Let me explain. So every month, I would go at my hotel, I would go to the restaurant and the banquet space, and we would do a physical count of the remaining liquor. How did it work? We used the scale, okay? We would measure the weight of each bottle. And then we would do it again at the end of each month. And then we would match what's in each bottle to the sales for each drink. And so what that did is it verified the pour for each bottle. It's a way of auditing to make sure that your bartenders aren't going a little too heavy on the pour. And it's also a way to verify that the number of bottles you have is actually there. Because once in a while, your employees might try to steal from you. Employees don't just steal cash, they steal time, they steal inventory. Go ahead, Zach.
Just a question about when you were weighing the bottles. When you did that, did you give an allowance for a certain?
Sure.
Yeah, how much would you say that is, depending on like a mid selling bottle?
No, that's
Sorry, I'm a bartender. I'm just curious.
no, it's a good question, Zach. So it depends. It's usually a couple of ounces here and there. It also depends on what the frequency of the sale is for that particular bottle. Like we know that most drinks will include either a vodka or rum, or something in between, right? And so because we know what the bases are, and we know that the vast majority of sales are from the house brand, um, we would apply like a factor, right? And it's usually like, oh, maybe 6 ounces a bottle. It depends, but usually there's some leeway, right? We're not that crazy. We know that the bartenders are going to be a little heavy-handed here and there. It's expected in the business. Or you might miss a pour and you just threw an ounce down the drain. Okay, life happens. So we know that that's a risk. Yeah.
Thank you.
So yeah, absolutely. So to control it when we're weighing things, we know that there's going to be some factor of loss. So that's why we try not to go too much out of control. But what the other part of the story, Zach, that I was going to get to is we would do physical counts of the full bottles as well, right? So it's like the partial bottles, the ones that are open and being used, and the full bottles. And as we're doing the inventory, we're documenting what we have on hand, and we're matching it to what we purchased. So you have your purchase orders and your packing slip. And now what you're doing is you're auditing what you have on hand, and you're comparing that to your sales. So, it's kind of like the good old saying, oh, it fell off the back of the truck. Do you think a whole case fell off the back of the truck? No. So we would do physical counts of each full bottle as well, and go back and compare it to our packing slip and our purchase our purchase order and our sales. And if we notice that a whole bottle's gone missing, then there's the good old other control activity, looking at all of the security cameras around the bar, looking at the back cameras in the parking lot, etc., to find out what happened to that bottle. So, and Zach will tell you, in the service industry, there's a lot of theft, and that comes from the employees and the customers, but mostly the employees. And and sometimes they don't know that they're stealing. Because sometimes you're like, oh, I'm going to give that customer an extra drink because I'm a nice guy. That's nice of you, Zach, but that's called stealing. You're stealing from your employer by doing that, by not ringing in that sale properly, right? Because you're using inventory inappropriately. That's called theft. Right, Zach? Tell me.
Yeah. And what my restaurant does is we give away items, but they all have to be accounted for in the system. So we keep track of it. We still send the ticket, but we just make sure that the manager knows, and then they put it in a separate bucket,
Log. Yeah.
so that still gets counted in the inventory sales.
Exactly right. Exactly right. Yep. And that's very common practice. So like, and you remember how earlier we were talking about like customer discounts. It's like, yeah, you can give a customer discount, like if they have like a coupon, or if there's like a sale going on, or whatever the case is. When you ring it into the register, you make sure to apply that sale, right? So another quick story, another bartender thing. So Zach, I don't know if you guys do this at all, but just hear my story, and then you can tell me if you guys do this. So at the hotel restaurant, we would have, your bartenders would be there. So There's a couple different ways that they do this. That's why it's so important to have these control systems. The bartender would go to the customer would place an order. Bartender would tell them how much it is, right? That drink's $5, that drink's, whatever. And so then they would, especially with cash, they would take the cash from the customer, go over to the register, ring it up as something else that costs less, pocket the difference. Ooh, that one stings. It happens more than we like to think. Here's another one. We got a customer who comes in, and they have, and this is common with hotels, they have like an allowance, okay? So like the hotel front desk will run a special, come stay with us and get dinner and a drink or a meal voucher, my favorite, meal vouchers. So they come in, they go to the bar, bartender rings it through as a meal. I've seen it. I've seen it all. I've seen everything. Or they'll ring it through with a coupon and not actually have a coupon, right? There's so many different ways. And so, Zach, do you have any other stories like that? I mean, we know those kinds of things happen.
Yeah, we use a lot of credit cards more than cash these days, just because the nature of
Sure.
neighborhood and I bet like in a tourist location they use a lot more cash, but that I mean even those things help us keep account of transactions, and most of the time the restaurant that I work for, they want you to give away free stuff almost with every customer. So they make sure that they account for all of it, and things go missing all the time. I mean, it's easy to just take a dessert out of the dessert tray and walk home with that, and I've seen people do that, and it's when people don't think there's any consequence to their actions, there's a tendency for people to take advantage of systems. And so that's why we have accounting systems, just to keep track of things and just to see if it gets out of hand, right?
Yeah, that's 100% right. Yep. Yeah, thanks for sharing that, Zach, with us. It's always good to hear the stories from someone else other than me. But yeah, it's and that's really the overall importance here, and that's why I'm spending so much time talking about it, because in business, especially if you have a business, it's so important to have control over everything that's going on, especially when it comes to your assets. And thank you. Thanks for sharing. The fourth one on here is information and communication. So big companies will have like a whole department for communications. They have press releases. They have ways of sharing information with customers through emails that's written by executives, right? All of that information is controlled. Yeah, information that you communicate to your customers, very controlled. Like, for example, some of you, like, maybe you work for like a call center. Even the way you answer the phone is controlled, right? There's a script on it. You have a customer's name, the same process every time, right? It's a way of controlling communication. And information is also controlled. Like, I'm not going to tell just anyone what my costs are, right? Of something like there's only certain people that I'm going to tell that to. So controlling information and communication, very, very important. And the last one's monitoring. It's a general term, but you monitor everything. I monitor the transactions. I monitor my spending. I monitor my income. I monitor my employees' behavior. I monitor my inventory. I monitor, you name it, right? But these are all about controlling the business. That's what that structure tells us. And what does it all do? It establishes responsibilities, helps us to maintain adequate records, Make sure that our assets are controlled by what we call bonded key employees. The word bond, okay? Bonded key employees. People with the keys, basically, is what this means. A bonded employee means that the employee has signed agreements with a company. The employee holds a key to the safe or to the whatever, and that employee is also insured. So that's what we mean by bonded key employee. It's that employee has additional assurance with the assets of the company, and that's typically your C-level suite employees, CEO, COO, CIO, all that jazz, and your general managers, your managers, your high-level associates, your leads or whatever you call them. Those are typically bonded employees. They're the responsible for the assets, basically. Oh, this next one's so important. I'm going to talk about these next two, 4 and 5. Separate record keeping from the custody of assets. Yes, you don't want your accounting records sitting there with the other assets. Sitting there with the cash. I keep my ledger locked up with my cash. No, don't do that. Why? Because anyone could go in there and manipulate that data. All right? So it's important to make sure that the custody of the assets is separate. For example, and I'm sure Zach could tell you about this too. So at the end of the night, we count the till, right? The register. You count the cash in the register. You count it up, right? And you record it, and you include your register tape. You take out down to what we call the bank level, like $100 in the register, and everything over $100, we take it out. We put it into a safety deposit bag, write the amount on it, include all the receipts. We bring it over to the safe. Very common in retail business to do that. Very common in the service industry to do that. Yeah, absolutely. What you're doing is you're having a separate record keeping from the asset, the cash. The cash went into the safe, into the deposit bag. The record is in the register tape. Also, we divide responsibility for related transactions. Here's an example. As a financial controller at the hotel, we had separate responsibilities. Okay? I had one person for accounts receivable. I had one person for accounts payable. I had one person for payroll. And I had myself, assistant controller, and general manager. If I needed to pay a bill, I would go to my accounts payable. Accounts payable would print the check, attach it to the bill, and then give it to me. I would sign it, the check. I would then go down to the general manager. General manager would also sign the check. That is called divided responsibility for related transactions. You're going through a process of validating that check is being paid for that purpose by having 3 different people verifying that that's what's happening. Very important to do that, because a person in accounts payable, they could just be printing checks and sending it to themselves otherwise, if you don't have a checks and balances system in place. Number 6, apply technological controls. Yeah, no kidding. That's everything now. Nowadays, we have biometric scanners. We have 2-factor authentication. We have security cameras everywhere. There's so many pieces of technology that help to controls to our assets. And this last one is perform regular independent reviews. That goes back to what I was telling you when I did the audit on the liquor at the bar at the hotel. It's like we go through these regular independent audits to verify that our assets are accurate. What we have on hand is accurate. And really, everyone's responsible for the business, right? You know, whether it be the employee who the customer first sees, or be the general manager or the CEO. Everyone's responsible for something, and so it's important that those levels of responsibilities are clearly established. Certain tasks are assigned to one or a few people, and that fault can be determined. So, like for example, in retail, usually the person who's counting the cash is not the same person bringing the cash to the bank. You got two people for that, okay? Because that person who's counting the cash can easily just be like, this is the amount. It's like, is it? So that's why having two different people for that type of task is important. Because we can determine who's at fault should something happen. Yeah, it's amazing what people think of. But the overall point to having these important maintaining records is to protect the assets, help management monitor activities, and it's important that our records are detailed. We follow the chart of accounts. We use printed forms, have pre-numbered sales slips, computerized point-of-sale systems. All of this helps us to maintain our records. That's why in accounting, like there's so much detail that goes into every transaction, and it's really all about the protection of the business, protection of the assets, and of course to have clear, accurate records from our sales. For those bonded employees, we insure against loss. Those employees handle a lot of cash and other assets, and so they should be bonded. The word bonded means that they are insured. They are they actually help to protect the assets, but they're insured. So if that employee goes and decides to take that cash home with them instead of the bank, that the company's insured against something like that happening, or in the event that something like that happens. I have two different people. It's important to have more than one person controlling assets, and that's separate from the accounting records. Helps to reduce risk of theft or waste, and it also helps to. This last one is can be risky, but the other reason why it's important to have different people for different reasons is to prevent employees from colluding together to commit a fraud. Having more than one person for the same transaction or similar transactions helps in terms of like a checks and balances type system. And that goes back to the example I gave you with having two signatures on a check. Having different people do different things that are related to the same transaction. This also helps prevent fraud and errors. With respect to the technology, again, there's a lot of different components of technology. That time clock that you all punch when you go in and out of work, you punch in, you punch out to go to break, you punch back in, you punch out to go home. All that does is it tracks the amount of time that you actually worked. Now, Yeah, it can be manipulated. You could have one of your colleagues punch in and out for you. But you know what we had at the hotel? A security camera above the clock. So, and nowadays, fingerprint readers, biometric scanners, two-factor authentication. Yeah, it's hard to beat that time clock. Same with the cash register. There's usually a security code you got to punch in to be able to access it. Uh, so many different methods. And the independent audit and review, so important to have somebody from the outside of your department auditing your inventory. That's why the accounting office would be the ones going down to the restaurant to count the amount of china, the amount of liquor, or the accounting office going to the housekeeping department to validate the amount of linens on hand. It's like, so that's, you can't have the same person in that department doing that because they can just simply manipulate the number. That's why it's important to have independent reviews. And then once in a while, you have somebody from outside the company coming in to audit. Like that, companies like Regis, they go around to large retailers and they do physical counts of inventory and then they put like a little post-it. You know, so important. And all of this together works to really reduce errors, to increase efficiency within the business. Sometimes internal controls don't always work. It doesn't work usually when there's human errors, human fraud, a triple threat, cost benefit. People do things for both because they don't care, they're confused, they don't know the processes. That's human error, okay? But then there's also human fraud. They intentionally do the wrong things for financial gain. Yep, and so it's important to identify the limitations of your internal control system. So, okay, so we talked about fraud, we talked about internal controls. Now I want to talk about the most important topic of this whole thing is cash. It all revolves around cash to some degree. It's so important to control cash flow. Controlling cash involves things like separate record keeping from cash disbursements are made by checks, and cash receipts are deposited into the bank. That's how we control the physical flow of cash. So what is cash? In accounting, cash includes things like currency, paper money, coins, checks, cashier's check, certified check, money order, credit card receipts. That's all cash. We call credit card receipts cash because it flows right into our bank account after we swipe the customer's card. Yep. It's cash. It's cash going into the business. So paper money, coins, deposits, checks, cashier's check, certified check, money order, credit card receipts, it's all cash. That's what you see, that's cash. It's cash. We also have what we call cash equivalents. Cash equivalents are anything that can be quickly converted into cash. I could quickly sell my security to get cash, or sell my investment to get cash. Yep. We call that cash equivalents. It's important to know how much cash the business has on hand in order for us to be able to pay our current liabilities, my accounts payable. Do I have enough cash on hand to pay my accounts payable? Do I have enough cash on hand to pay my wages payable, my taxes payable. It's important to know that the business has enough cash to pay its current liabilities. Very, very important. So because cash is so important, we got to know how to manage it. When I receive the cash, when do I receive the cash? And is enough cash to pay my bills? The business needs to maintain a certain minimum level of cash. You got to have enough cash on hand at all times to meet some unexpected event or to make sure I have the ability to pay my current liabilities. In most businesses, there's a separate bank account for payroll. All right? I have a separate bank account just for payroll, and I make sure to transfer enough cash into that account to make sure I can pay my employees. Because if you don't pay your employees, that's bad. So most companies have a separate bank account for that. And they have to maintain a certain level of cash in that account at all times. And the other bank account for day-to-day operations of the business to ensure we have there's usually a minimum amount of cash in there, make sure I can pay my current bills. Effective cash management implies that I can collect on my accounts receivable on time. I can pay my liabilities. That's why it's important to plan. So I always have like an internal control system for cash. Cash is like the most risky asset of any business because it can be quickly diverted, right? So it's here's an example of the flow of cash from over-the-counter receipts. So if you're at a restaurant, if you're at a retail business, if you're at somewhere where we're constantly dealing with cash, we ring up the sale through the register. We receive the cash from our customer. We put that into our security deposit bag, and it goes into the safe. Then the accounting office will receive that safe deposit. They'll record the transaction based off of the journal slip, or the deposit slip. And then someone else goes and deposits that cash. Follows a physical flow of cash. Sometimes we make errors. Sometimes we forgot to give somebody their change. I've done that before. Or sometimes we gave them too much change. I've done that before. It's human error. We're not perfect. So we have an account for that. It's called cash over and short. We make errors. We didn't give somebody enough change or gave them too much change. Or I forgot to ring in a sale or something ridiculous like that. So here's an example. We have a cash register that shows $550. But then when we counted it, there was actually $555 in cash in the drawer. So maybe somebody gave us too much cash. So we debit the cash, the actual amount in the drawer, in this case $550. We credit sales, $550, because it shows that we made $550 in cash. We credit an account called cash over and short, $5. That $5 is the difference between the cash I actually have and my sales. So I guess I forgot to give that customer $5 in change, or the customer gave me too much, didn't realize it. I didn't realize it, put it in the cash drawer. Something happened. But I'm over $5 in cash. It happens. Yeah. Yeah, yeah, Esmera, that's yeah, that happens. You, you know what? I've done that so many times at my first job too, and second job and third job. Management gets a little upset if you're over or short because it creates this type of situation, especially if you're short. Yeah. Uh, when you count your till, the register, at the end of your shift, and you pull your sales the tape out of the register, and your till, and you count the till, the register, and you match it to the sales, and you put the rest in the bag with this receipt, and your boss says, "Hey, there's $5 over. You forgot to give somebody their change," and they write you up for that. Or the opposite also happens, right? Yeah, that's so common. That happened to me too. So, this when you're dealing with cash, life happens. The cashier's not going to be perfect. People aren't perfect. We make errors. Here's an example. So, customer comes in, and sometimes I give them a little too much back. Hey, don't round up either. Yeah, make sure that pennies, they count everything to the penny. Yeah. So, okay, in this example, my sales shows $625 for my register. I counted my cash. It shows $621. Uh-oh. That means that I gave too much change. I debit cash, $621, because that's what's actually in the drawer. I debit my cash over and short account by $4 because I'm short by $4. If you're over, it's a credit. If you're under, it's a debit. Cash short, debit. Cash over, credit. That's how you remember it. And we credit sales. You always credit sales because that's how you recognize your sales. Yeah, I've been on both ends. It's all happened to me at some point. Sometimes we'll get cash in the mail. Hopefully not actual cash. Hopefully it's a check. Never mail cash, please. Even if you're sending your grandkid a $5 check in a card, don't mail physical cash. If you're going to mail cash, it should be a check, not physical cash. Because, God forbid, something happens. Yeah? I'm just saying, don't mail physical cash, please. In business, we have two people responsible for getting the mail. Usually we have our office secretary. She'll get the mail, or he'll get the mail. They'll get the mail. And we have a cashier that receives cash, put it in the bank. Record keeper records the amount of cash received. And we apply that to the customer's accounts receivable. But it's important, that's how we control cash payments, cash receipts. And when we pay cash, it's always made by check. Usually you have more than one person sign the check. Or it could just be one person, that's fine too, but the person printing the check should be separate from the person signing the check. And there should always be a budget. Another important concept I want to talk about real quick is called the voucher system. Vouchers are sometimes used in lieu of cash. Okay? For example, at the hotel, sometimes we would have guests arrive by taxi. and the hotel would have a hotel shuttle for the airport. Guests missed the shuttle. We send a taxi out. We pay the taxi using a voucher. The voucher system was established for a couple of reasons. It verifies, approves, and pays for liabilities for the eventual cash payment. So obviously, I'm not going to give the voucher to the taxi, but I apply the voucher to the business, and I pay the taxi using cash. You can't just pay cash out. You have to have something to identify the reason for that cash payment. In that case, you use a voucher. Vouchers are also called stubs. It's like the bottom portion, right? Let's say you pay your utility bill using a check. On the bottom of your utility bill, it's called a voucher. You tear off the bottom, you write the amount, you put that with the check in the envelope. Yeah. It's another way of tracking that payment. Verify that it gets applied to the right account. And this is visual representation of how that works. Petty cash. Oh man, I hate petty cash. Petty cash is a pain in my ass. Here's why. So petty cash. At the front desk of the hotel, we would have a petty cash fund, about $100 or so, for various small payments that we got to use cash for, especially if the accounting office went home for the day. I can't go to the accounting at 2 a.m. and ask for them for a check. They're not there at 2 a.m. So you're in the night audit. You need to go get stamps from the machine or whatever. You're going to use petty cash. You have a minor repair, low cost. You need supplies for the front desk. You're going to use cash. You got to pay the plant lady who comes and waters the plants in the lobby. Going to use cash. Okay. Anytime you're using petty cash, make sure you get a receipt and put that in the petty cash drawer. So that way, the accounting office can replenish the petty cash fund. Petty cash fund's easy to establish. You debit an account called petty cash, and you credit cash to decrease the cash. You're using physical cash, putting it into a safety deposit box or whatever at the front desk, and they'll use that cash for small things, especially if the accounting office isn't there. So you debit petty cash, credit cash to establish the fund. So throughout the month, you'll use cash for various reasons. Small things, yeah? Small transactions. Tile cleaning, transportation for merchandise, customer package delivery, post office stuff, office supplies. We have all the receipts, for each item. Put all the receipts in the petty cash fund box. At the end of the month, the accounting office makes a general journal entry for each expense. And then they credit cash to reduce the petty cash fund. To reimburse the petty cash fund, sorry. So to increase the petty cash fund, we debit petty cash, credit cash. To decrease the petty cash fund, we debit cash and credit petty cash. I don't know how the word petty came about. I think it just means small. Petty cash, on occasion, is used when there's an over or under in the cash drawer. So we would allocate it, petty cash, to, balance the cash register. Let's talk about the bank. Because we're talking about cash, right? We got to talk about the bank. The bank provides us with an account, a bank statement, checks, signature cards, deposit tickets, EFT, which is how most business banking is done now. These are all bank services. These are all things that bank provides to the business. We use a deposit ticket to show money going into the bank. Deposits, check numbers, cash amount, etc. These are all examples of deposit tickets. Shows us proof of deposit. Remember, it all goes back to the paper trail. Businesses uses checks, physical checks, for pay various expenses. You all know what a check looks like, hopefully. And if you don't, I don't know. I don't know what we're going to do when everything goes digital. At the end of each month, beginning of the next the bank will send you electronically, probably, sometimes in the mail, a bank statement. The bank statement shows you all the checks and cash you used from the account going out and all the cash going in. And it shows you your debits and credits. But remember, here's the thing I want you to remember. Yeah, I know, right? Everything's digital. Here's the thing I want you to remember when we talk about the bank. Debits and credits are the opposite at the bank, okay? Cash going out, cash coming in. It shows all the different transactions, checks you've written, cash you brought in, etc. It shows you the prior month balance, checks, total deposits, and the current balance. We take this bank statement and we do what's called a bank reconciliation. A bank reconciliation is simply taking the statement from the bank and comparing that to the transactions in the accounting system. We do that every month, at the end of every month. And what we're doing is we're validating our cash amount in our accounting system, that it matches the bank account by adding and subtracting various components. And it's so important to do it because you need your cash balance in your accounting system to match what's in the bank. So on your balance sheet, you have that cash line item. That cash line item should match what's in your bank account at a given date. Yeah, we do that through the bank reconciliation. Cash balance plus deposits minus outstanding checks plus or minus any bank errors or fees equals the adjusted cash balance. And then on the books, or on our accounting information system, cash balance based off of our accounting information system plus collections and interest minus bank fees and non-sufficient fund checks plus or minus any errors equals the adjusted cash balance. We see that the adjusted cash balance from the bank matches our adjusted cash balance for our accounting records. That's how you reconcile. You're matching the bank account balance with your accounting information balance. And what we do is we check. We check the check numbers off with our accounting information system to verify that we actually got paid. Just kind of shows you the steps that we go through. But bank reconciling, so important you do that every month. Don't skip that step, especially if you're a business owner and you're using something like QuickBooks or whatever. please make sure that you do the bank reconciling every month, because that'll help to verify that your balances actually match for cash. Very important. And sometimes there might be an adjusting journal entry that needs to be made. These are just some examples of those. Okay, couple ratios and then we're done. I know ratios, right? It seems like we do a lot of those. A couple of important ones. Days sales uncollected. This shows us how long we are not collecting cash from our accounts receivable, right? It's like how long it takes for us to collect our accounts receivable. So we take accounts receivable divided by net sales times 365 days. Tells me how long it is before I collect on my accounts receivable. Obviously, lower number of days, better. Yeah. And we'll just review a little bit. You have to have a paper trail. Here's an example of such. Purchase requisition, the purchase order, an invoice, receiving report. These documents verify the transaction, that it actually occurred. I requested the transaction. I have a purchase order. When my stuff comes in, I have an invoice and a packing slip, also known as a receiving report. I match all of those together with the check. It verifies to the accounting department that what we actually purchased, we received, and what we received is what we're paying for. It establishes the paper trail. The invoice approval, we give that to accounts payable. They print the check. We attach a copy of the check to the purchase requisition, to the purchase order, to the packing, to the receipt, the packing slip. We attach all that together to establish the paper trail and to verify that we actually paid it. All that comes in handy when you ever get audited. Vouchers used to complete the invoice. Check is issued and approved. And it's important that we have that paper trail. So important. My friends, that's the conclusion of our discussion on cash, fraud, internal control. Any questions, comments, concerns?
Nope, no questions.
Thank you, Tiffany. Appreciate that. Okay. Straightforward. Yes. Yeah, exactly. Everything has a process, a purpose. We have paper trails. That's the overall point to this whole chapter, really. It's all about controlling the business. So, with that, let's just recap real quick. Again, very busy week. Cybersecurity. Good, Christian, great question. Do banks have specialized cybersecurity? Yeah, I hope so. For the most part, yeah. Christian, great question. Banks are getting a lot more sophisticated. So you can't just log in to a bank account anymore. A lot of times it requires what we call two-factor authentication. So you log into your bank, you got to enter your phone number. It's going to send you a text message. You got to enter the text message code, right? That's called two-factor authentication. Or you log into the bank account, it sends you an email with a code. You enter that code to access the account. And that's after you've entered the password. It's getting a lot better. They also identify where you're logging in from using the IP address. it's still not perfect. I mean, fraud still happens. We know that. You know, people will still manage to get a hold of your bank account somehow. But it's getting a lot better. So the answer is yes. Cybersecurity is heavily involved with banks, and it's getting better. It's improving. So great, good question. Yeah, absolutely. To recap, where we are. We are in week 4, halfway through this course. Halfway through the course. It's an 8-week course, so week 4 is halfway. What's due? February 6th. That's this Sunday. You owe me 3 things, of which cannot and will not be late. The midterm exam, Chapter 7 quiz, Chapter 8 discussion, and the midterm exam. You owe me all 3 of those by Sunday night. Okay? I will not and cannot accept the midterm exam late. February 6th, 11:59 p.m., that exam better be submitted. Okay? It's 10 questions, open book, open note, mix of true, false, multiple choice. It covers chapters 1, 2, 3, 4, 5, 6, 7, and 8. It's about 1 question from each chapter. Again, open book, open note. It's open right now. You could even review the questions if you want to. Open book, open note, open internet, open everything. There's no reason for you not to get 100% on this exam, I promise you. So please, again, Chapter 7 quiz, Chapter 8 discussion board, midterm exam. It's all due this Sunday night. Do not be late with that midterm exam, please, because I have to report your work on the midterm exam to the university by Monday of next week. So, questions? Y'all good? Okay. All right. In the meanwhile, if you think of anything, you need any help, you can email me, call me, set up office hours, whatever it takes. I'm going to be here for you. And as always, I want you to please stay safe, wash your hands, do the right things, and I'll see you all again next time. Thank you all so much.